Welcome to Total Money Management Podcast. I'm back with Steve. How you going, Steve?
Good, mate. Good.
Nice
Fat and happy after Christmas.
I was going to say, I've eaten enough ham for probably most of Australia.
I try to sort of avoid too much junk food, but it's just like, yeah, we can do nachos again, sure.
Yeah.
I'll have another glass of red. I'm watching the cricket.
Oh, I went through a bit of gin, actually. It was nice.
Oh, did you?
Yeah.
Right.
There's a market up at Redcliffe near where I live, out in the middle of nowhere, and there's a gin stall, a distillery.
Oh, right. Okay.
And they come in every few weeks, and it just goes nuts. There's like citrus and berries.
Right,
and
okay.
Beautiful.
It tastes really nice.
It's really nice.
Yeah,
and it's cheap as well.
Which is really bad.
So, and I was just saying before why I'm not sleeping. I'm like, oh, probably still drank about a litre of gin.
Yeah, it's either because of the gin or maybe you should have a drink of gin.
Exactly. Well, look, we're
either way, it can't hurt.
Oh, I know.
Righto, what are we doing?
We're covering 16 to 20, and we're not going to spend too much time going on about how the market's overvalued, because I think we've been talking about it for probably the best part of 12 months now on most podcasts.
And what's the big issue this week? Oh, the market's overvalued.
But it's like we can spend an allocated, allotted amount of time talking about it. But I think where it becomes interesting now, right, is the market's overvalued, and whenever there's an expected catalyst event, that's usually not the thing that tips it. But
yes.
But there's so much going on at the minute with, I mean, you were just talking before about Musk and the changes he wants to make.
So there's suddenly, it's the unexpected event, which is really, I mean, you imagine if the problem with risk and returns, the only return that's not a risk is sort of cash in the bank, right? Even bonds have an element of risk over time, right? You put your money in a bank, it's got a risk, but it's tiny, right? And the government guarantees it if it's less than 250 grand anyway. But my point being, what the future, investing is about putting money out now to get it back in the future. What's the risk? Well, the risk is things that you don't know, right? What could happen that you can't really put a probability on? And that's what makes investing, quote, risky, right? So by nature, by its very inherent characteristics, you can't say, oh, Jacob, March 3, 2025 is, there's going to be an earthquake in Tokyo and the markets are going to absolutely decline.
Yeah.
Right. Well, you can't do that, because if you did, you go, okay, well, that means what I'll do is I'll go absolutely full bore. I'll go and leverage up billions of dollars till March the 2nd, and then I'll sell out.
Yeah.
Right? Well, you can't do that. So by nature, all you can say is, I don't know what the event is, and it can go on longer, but I'm just saying, if you look at the fundamental returns in terms of what we talk about, which is the yield, it's really, really expensive. And according to history, you'll probably lose a lot of money
over the next decade.
Yeah, and it could all happen in 12 months, like the GFC. So, the Cape in the GFC went from like 29 in 2007 to 13 in 2009, right? Well, that's a huge decline. But that's not a decade, Steve. And it's like, I know, but that's why I say you've got to look at the yield now compared to the average yield over decade returns. So in other words, CAPE is a 10-year indicator. I don't know what you'll get in the next year or 2 years, but what I can sort of say is, look, over the next 10, you're probably not going to get a lot if you invest now.
Yeah, so it's when you invest, what's your investment time frame?
Yes.
If you're looking to invest over a year or two, by all means, dance near the door.
Yeah. If you want to go hard, go hard. Yeah. But just be aware that you could be in trouble. But one more point, which is really important. What people do is they start in 2009, okay, or whenever you start, and you make a bunch of money. Now, what you got to remember is it's not about the money that you've made. What I'm saying is the CAPE is now 39. You're going to get roughly 2% or probably zero over the next decade from now. Now, you might get more, you might get less, right? But I'm just saying, according to history, listen, the returns are not going to be well below average. Okay. Now, if you say to me, well, yeah, Steve, but I've made 13% compound over the last 15 years. What I'm saying is that's great, but that, Steve, I had 100,000, now I've got 800. And what I'm saying is, well, okay, but that 800 now that you've put into the market is simply like buying $800,000 now, right? So I understand you've made profit in the past. It'd be a really good idea to rebalance and take some of that off, because that 800 now, I know you made 13, but over the next decade, that 800 is probably going to make 2. Are you happy with that 2%? Now, if you say, well, no, I'm not, you say, okay, well, now you need to rebalance and say, oh, well, I'm going to go and buy a cheap property in Brazil, or I'm going to move into emerging markets, or, you got to dynamically manage that according to what the returns are. And that's why the projected returns, that's why I think Warren Buffett sold out of Apple. Great company, absolutely. Worth, $3.5 trillion, absolutely. It's had a stellar run, absolutely. It's run well, absolutely. But it's batshit crazy overvalued at 10 times sales. So Buffett says, look, I've made heaps of money in Apple. I'm just going to keep it. It's like, no, he's not. He's saying it's pretty unlikely to do this for another decade. Now, if it's absolutely halves in value in 2 years, bingo, he goes back in, right? But that's the whole point of it. You've got to look at it from now, what you've got in the market now, or what you want to put in now, and what is the projected return.
Yeah. Well, if that to use like first example, if that 800, even if that 800 stays at 800 for the next 5 years and it goes 850, it back down to 750, ends at 800.
Yep.
You then fall into this trap of suboptimal returns.
Yeah. Well,
because time takes away.
Yeah. Your 13% compound becomes 9% compound because you've got 5 years going nowhere. And that's what happens a lot in property. You get long periods where it doesn't go anywhere for 15 or 20 years, and the price doubled in the previous 10, and then it goes nowhere for 20. And when you put the average return over the 30 years, you go, oh, actually I only made 2% per year, and inflation was running at 2, so I didn't make any money. And that's the point with valuation.
Yeah,
right?
Well, it's with property, it's usually the kids that inherit the property. They go bingo.
Kids are the ones that make the money.
Rather
absolutely.
Than the parents. Or
absolutely. That's why parents are able to put their kids into the market, because they built the equity.
Yeah.
Right. But the arguments I have within my family are saying lots of old people are going, stuff the kids.
Yeah.
Bugger the kids, they can be on their own. We're gonna spend all the money and bloody we'll go to Europe and have fat holidays, and they're doing that sort of stuff. So that's why I'd say it's really tricky these days, because in the old days, basically there was three kids, maybe 4, right? The parents had dropped dead. You'd get $100,000, and that'd be enough to, help you pay down your mortgage, or put you in a position, Jacob, where you could go, okay, now we can live a little bit more comfortably. Not necessarily like, woohoo, we're millionaires, but at least to say, oh, well, actually now we only need to pay $200 a week on the house, not the $350. You get an extra $150 a week. You got more to spend. You got a better sort of lifestyle. You're not catapulted from, the working class into Elon Musk territory.
No,
but it just allows you to have a little bit more of a nicer life.
Yeah, you can get your head above water a bit. You might go on a holiday instead.
Yeah. Instead of doing Redcliffe, you're now doing Bali for a week or something, right? Because you got a bit more money.
Yeah.
But yes, indeed, The thing with property is the last 30 or 40 years, it's become an investment class, not a house, right? And that's a big difference, right? Because people are now openly buying and selling, investing, speculating, call it what you will, on residential property. And that's why we said in the special, you've got to look at it differently now.
Well, I play golf with a guy who's bought, I think, 6 houses in the last 4 years or something, and flipped them all. And I'm like, he's done really well. Good on him. But
that's what you got to, that's what you got to do.
Yeah.
Right. Because we know the really extended long-term returns aren't that great. And like you say, the kids just get a bunch of money, not because the old man made it, occasionally the old man buys a property and it's in the perfect area and they build schools, houses, and it actually does really well over the long term, right? The old man buys the equivalent of an Apple stock, right? And you go, man, the old man, hit a 10-bagger, right? Generally what happens is if you calculate the returns, all your parents did was save money in this thing called a house. They drop dead and the house that they bought for 50,000 sells for 800, which sounds fantastic. But when you do it over 30 years, put in the costs and stuff, you go, actually, the old man made 1%.
Yeah.
But I'm getting...
But the kids getting it.
Yeah, the kids each get 250 grand and go, woohoo.
Yeah.
Right?
Well, look, that's a segue into real home prices. And you made a good point, I think, when this went out last week about the Chinese Communist Party who haven't been able to save or are not saving their housing market over. And if the biggest communist party in the world, who literally control everything, can't save their housing market, then it's a big question mark on everything else.
Yeah.
And we're starting to see more and more people agree with that concept now, I think, especially on the socials.
Yep.
Which is positive after about 18 months of harping on about it. But it still begs the question, so do you just accept it and housing does it go anywhere?
Well, essentially, yeah. But this is, I talk about this a lot. Particularly in, if I can put it in blunt terms, the Western world, what we generally think is, with a focus on individualism, the philosophy is, Jacob, you can make it, right? What was I watching last night? Oh, I was watching The Equalizer, right, with Denzel Washington, with my son. And, he's helping the poor black kid who's an artist, but, he's going to go and murder someone and he's, they're drug dealing and all this sort of stuff, right? And he says, Miles, you can make it if you want to, you've got real talent, you can make it. And Miles is like, the world sucks and it's really, you can make it, dude. That's so American, which is, it doesn't matter who you are, the colour of your skin, you can make it. Well, yeah, okay, the odds are pretty slim for Miles, right? Yeah. But that's not the point. The point is, the philosophy is the individual, if you just keep going, you'll make it. Well, sorry, that's not true, right? Some people keep going and just don't make it. They have bad luck through their life or whatever. But my point being, you think you're in control of a lot more than you actually are in control of.
Yeah.
Right? And that's where it becomes an issue in investing, because what we do is think, well, Jacob, you just remember Joe Hockey, right, in 2015 when they were talking about how hard life was in some places. And Joe Hockey said, well, just go and get a better job. I mean, that's the dumbest fucking statement, because some people just can't go, he's bloody right. I'm going to go and, I'm going to be a GP.
Well, yeah, if 10 million adults in Australia just all decided, I'm going to get a better job.
Yeah, we're all going to get a better job.
There'd be no one doing anything
else.
Well,
first of all, there'd be no baristas. Yeah. There'd be no one packing my groceries or, stacking the shelves. Yeah. So the issue there is just saying, again, you can buy a stock and you can sell a stock. Everything that happens in between is, if I do it, is up to you. So I can buy a stock from you and I can sell a stock to you. But if I come back at any of those points and say, Jacob, I'd like you to buy my stock, and you go, I don't want to buy it. No, mate, you don't understand. I'm in control, right? I'm in control of my whole life and portfolio. So can you just please buy it? And you go, no, Steve, I'm not buying it, right? Or you say, Steve, I'll give you 80 cents, not $1. I go, no, that's not the deal. I'm in control, bro. Yeah. That's what I'm talking about. And that's why I'm saying, if governments, as this huge entity that can influence things, can't save a property market or a stock market, because there's millions of individual buyers and sellers. And so the government can't put a blanket ban on property sales, right? They often, you find I won't say often, but what you find occasionally in markets, particularly in Asian markets, is they put a ban on short selling.
Right, yeah.
Right, they did that, I think, during the GFC. Yeah. I think it was in South Korea. But what they do is just make it worse, because what you're saying is, okay, I'm not selling short, but I'm just going to sell all my stock, right? Because the government's saying the market's shit and it's going to go to hell in a handbasket. Well, you go, oh, well, I won't make money out of shorting it. I'm just going to sell everything.
Well, if you if a government pauses the ability to short, that just says it all, right?
Yeah, that says things are really bad, right? Things are going to get worse, and we don't want people to profit from it, okay? Which, what does that do? Makes things even worse, right? Because when they go, okay, reopen the market, it goes limit down again.
Yeah. I remember doing that throughout COVID with oil shares. I think it was.
Yeah.
Or it went down to. The futures went to minus whatever.
Yeah. It was oil price went negative.
Yeah, and so, the platform that I was using paused short selling as well.
Yeah.
I was like, Jesus.
But it's just that point again of it. Look, it makes it hard because you only know what you know, right? And so it's, as I say, it's the unknown stuff that gets you. And if it's unknowable, well, by its very nature, it's unknowable. So that's why Nassim Taleb talks about in his books, you have to, it's like insurance, right? You don't know what's going to happen to your car. What you can do is say, yeah, but if I have a really bad accident, I'm going to lose 40 grand in the car and I might run into a Mercedes-Benz or a Rolls-Royce.
Yeah.
Right? So what you do is say, all right, well, I'll accept insurance. I'll accept losing, $80 a month in lieu of saying, well, I might have an event where I lose 100,000, right? That's what insurance is saying is, Jacob, you don't know what's going to happen to your car, and we'll take the risk, right, of you not having a crash, and if you do, we'll stump up the money.
Yeah.
Right? And in the market, what I'm doing is saying, look, I understand the market may go higher, but I'm going to insure myself by buying put options that if it does fall, I can go, okay, my long portfolio's falling, but my short portfolio's rising.
It's hedged.
Right? So it's just like insurance.
Yeah. Or it's or with home prices, you're going, okay, I've just had 25 years of an absolute blast of a run. I'm going to sell my house.
Yeah. The difficulty with housing is, though, once you sell it, then you
got to buy into another market.
Well, yeah, and if
the
it's
same market,
you can't do it with your PPR. Well, you can, right? But again, the thing with stocks, I can sell out of stocks, and then I can say, right, I'm just going to sit here.
Yeah,
I'm going to sit here for 12 months or whatever, or I'll buy a little bit. Right. The difficulty with property is if it's your PPR, your principal place of residence, the problem is you can sell it and then you go, okay,
now what?
Now what? I'm either homeless or if I buy again, I'm probably buying in an expensive market because I'm selling in the market, same market, right? So if your house is overvalued, it's probably likely that most houses are overvalued. Or you say, okay, well, I'll go and rent for a period, which you can do. But at the moment, because there's, reduced rentals, it's really hard to rent a place or it's really expensive to rent a place. So it just gives stock. That's why we talk about stocks and property have different characteristics. Property's not as liquid, right? You can't just sell property and go, now I'll go and live on the streets and I'll put my money in cash, right? Well, you can't do that. So there's just different types of investment risk and liquidity and, all that sort of stuff with it.
Exactly. And I think this chart it's a pretty good chart that shows property goes up and down as well.
Yeah.
It's not a straight line.
And these periods here, right?
Yeah.
Where, and that's why I'm saying that's from when?
1890,
right?
Yeah.
Well, you've got to look at the period relevant, and you talk about this last week. You've got to match it with your time frame. So it's no good looking at the stock market and saying the average return over 100 years is 8%. But as we showed last week, but if you bought 2009, you're killing it.
Exactly, yeah.
But if you bought in 2000, you're not killing it. So that's where you've got to match the time frames and say, okay, what's the 10-year average return? Well, that's where CAPE becomes helpful.
Yeah.
Right? You can say, well, if I start now, CAPE's at 39, I'm probably going to lose money. If I start now and the CAPE's at 10, God, I'm going to have a great time. So that's where it's really important to learn that sort of economic history and match it with your time frame.
This is an interesting. I won't go through it. We're going to cover this in next week's, but there's an interesting kind of insert from Morgan Housel for the Psychology of Money.
Oh, yeah.
Which is saying, to give a more recent example, how you behaved as an investor during a few months in late 2008 and early 2009 would likely have more impact on your lifetime returns than anything you did from 2000 to 2008.
Timing the market, for goodness sakes.
But the paragraph before that says otherwise. We'll get into that next week.
Well, remember Buffett. Buffett in November 2008 said, buy American IM, right? Price to book was low, market cap to GDP was low, the CAPE was low. That's why Buffett is, and Howard Marks also says, when you buy is more important than what you buy, right? And that's what we're saying. And that naturally connects itself to timing the market, not time in the market, right? Because where this is the time in the market comes from the efficient market theory, right? And it's bullshit, right? I'm not going to bore you with it now, but it's been the dominant theory for 60 odd years, but it's not the way you make the most money. And Buffett himself says, we love that they teach this stuff, right? Because it gives me an advantage every day of the week, right? Well, that's when you look at it and go, gee, that old guy probably knows a little bit, and you just look at his record and he does well when he buys things that are cheap, right? He bought Bank of America when it was, insanely cheap in 2011. Might have even been the GFC. Yeah, it was the GFC. He bought Apple when it was at the low in 2014, timing the market. He just didn't buy Apple whenever and go, I'll put $1 million a month into Apple. Well, why would you do that if it's crazy over, expensive?
Yep.
That's really stupid. Like, I buy strawberries every week. Oh, this week they're $25. Oh, well, I just have to buy a punnet. It's like, really? Why would you do that? But people seem to think that's the way you should do your money because this thing of, I got paid this week, I need to do something with my money now. Yeah. It's like, no, you don't. You just want to wait for it. If I said to you, Jacob, listen, I'll give you 12% in 12 months, you go, oh man, I'm going to hang on to my money and really pile it up.
We should do an exercise, Steve, where maybe we can draw it out, where we go, okay, if you put $1,000 a month for 12 months, or
yes.
I don't know what it looks like, $1,000 a month, and versus saving that and putting it in when there's a cheap valuation,
yes,
and what the end return is. I think we might have done it in the Wells courses or something.
It is in Well too. It's again that rule of 72 compounding, right? So think about it this way. Here's a quick way of doing it. If you said to me, Steve, I want to double my money in 5 years, that means you've got to make 14.4, right, per year compound. If you make it 10 years, that's half of that. 14.4 is 7.2, right?
Yep.
So imagine we both start out, right? And you say, I'm going to invest my money now. And I say, what do you get? And you say 7%, right? And I say, okay, well, you're going to, let's say it's bonds, right? Oh, right. Okay, well, you're going to double your money in 10 years, right? Now, if I say it's stocks, I sit on the sideline and I go, nah, I want better than that. And I'm sitting there earning, say, 4% per year, right? So every year at the Christmas party, right, you come back and go, Steve's an idiot, I'm getting 7 and he's got 4, right? He's getting 7, and, I've got 7 and he's getting 4. Third year, Steve, you're a dickhead, you're only getting 4 and I'm getting 7. Bro, you got to get in on this, right? Then the market crashes. Then I say, righto, now it's offering 14.4, right, in stocks. Now I put money in stocks. In the 5-year period, I make more than what you have, right? Because your rate of compounding is lower, right? And so what I keep saying to people is compounding is not about time. It's about the rate of compounding, right? You can compound for 30 years. Man, that is great. No, because I only compounded at 2%.
Yeah.
Right? If I said, I compounded for only 10 years, people go, oh, he's probably not doing that well. And if I say, yeah, well, I invested when I get 14.4%, people go, well, Jesus Christ, he's doubled his money twice.
Yeah.
That's the really, really big point about compounding.
Yeah.
Right? And that's what Buffett does. He waits for the fat pitch.
People think that, geez, I've got a cough today. People think that you need to do that and pick the top or pick the bottom, and that's not the case.
Yeah.
You don't need, which is why I think people get confused. Because they're like, oh, well, I've got to pick the top and sell, and I've got to pick the bottom, and there's only a couple of days that you can do that. Yeah. And that's not necessarily the case.
Well, and see, again, what they're talking about, Jacob, all the time is this capital gain part of the stock market, right? And you've got to remember, as the price of the market goes up, and it goes up more than it should, right, by human overreaction, the yield is falling. Right, so again, it's the thing. What I say with property: if the rent's 50 grand a year and you buy the property for 500,000, you're getting 10%. Okay, that's fantastic. You should hang on to that because you're getting 10%. Excuse me. If I come along and go, Jacob, I love this property and I'm going to buy it off you, and I buy it for $1 million. If the rent is 50,000, I'm only getting 5%. Right? But you see, I've got drunk and gone, oh man, this thing's going to be worth 1.5 million. And if you say, okay, it's going to be worth 1.5 million, then you look at it and say, well, now the yield is like 3%. You see, so as the price is going up, if there's no corresponding increase in rent, right, in the same ratio, you're risking the money on the capital gain.
You're just speculating.
Yeah, and that's why Buffett says if you're a net buyer of stocks over your lifetime, you want to get cheap prices, right? Because what he's saying is you're going to get a better long-term compounding rate.
Yeah.
Right? Not just you're going to get a big capital gain in 5 years, but then it's going to be eaten away. And that's where the stock market gets carried away, not in the dividends, right? It gets carried away in the price. Yeah. And so that's why you see earnings per share is fairly steady in a long-term return, right? And that's what Schiller said. Look, we know dividends are roughly about 2 to 3% on average. So when the stock market gets carried away, like now, the dividend yield in the S&P 500 is like 1%. Well, I can get 4.5 or 5 in bonds. Why would I get 1 in stocks? Oh, yes, Steve, but it's going up at, the last 2 years, it's gone up 50%. That's what goes on. But if you don't take the capital gain and it falls down again, well, guess what? You never captured that money.
Yeah.
But everybody talks about that price movement rather than, you imagine if I woke up, every day I woke you up and said, listen, mate, the yield today's, 1.1. And then I woke you up the next day and go, mate, the yield today is 1.05. You'd be going, oh, this sucks, right? My yield is falling. This is awful. But it's flipped by you going, yeah, but Steve, it's gone from 1,000 to 1,100, right?
Yeah.
That's what goes on.
There's a bloke on socials yesterday, I think, or overnight, commenting, don't you lose more money waiting for the crisis rather than the crisis itself?
Yeah, this is a Peter Lynch argument.
Yeah. So
because, well, look, again, it's always tricky. It depends. But all I'm trying to point out is that the people who do say that, right, you imagine investing in 2000, you lose 50%, right? This is bullshit. Then you make 100%. This is great, but you're only back to square.
Yeah.
Right? You go from $1 to 50 cents in 3 years, then you go back to $1 in 4 years, then you go back to 50 cents in 2 years. So from 2000 to 2009, you've lost 50%, right? Now, people will say, oh, yeah, but those events are rare. Well, there's 2 in a decade.
Yeah.
Right? COVID, down 30-odd%.
Yeah.
Right? 2022, down 23%. Now, if you're retiring in 2022, you're going to be a bit pissed that you lost 22% of the final total where you had, money in the market. So, again, what this broad sweeping statement is time in the market. Oh, well, Jacob, you just got to suck it up through the 50% drawdown. Really? Why? That's like we showed last week in the market cycles chart at the end. It's bloody obvious when things are really batshit crazy, right? And it's bloody obvious when they're really cheap, right? That's, you can argue about it at the Cape's actually 37.6, not 39. It's like, okay, what does that mean? That means the difference between 2% and 1.9. I mean,
I think at the end of the day, it comes back to when did you get in, what's your investing time frame, and if the market crashes 30 or 40% the year before you're going to retire, you got to factor all that in because it's individuals at the end of the day. It's not one person.
Yeah, that's the difference.
Not a group of people, sorry.
That's the difference between talking about the individual and the market.
Yeah, and
I wrote a note to myself yesterday, I think, about I want to talk about that further because it's a really important point. sorry, let me give you this statement. I think it was something to do with this. The world has improved so much in the last 30 or 40 years, right? Thanks to globalisation and free trade, right? The world, okay? Now, I can go down to any city and go, listen, mate, how you going? This globalisation's kicking the shit out of it, eh? And he goes, mate, I lost my job. I was a general manager in a factory. Then I worked at McDonald's. And then I was paid $8 an hour, and then I had some shithead at 21 telling me what to do after 30 years in the workforce. The missus left me. You know, she's now got a new bloke. The kids are smarter than I am. Globalisation's a winner, right? That's why they voted for Donald Trump, right? Because those people are going, this sucks, right? And that's why the statement of, oh, the world's gotten so much better is a little bit nebulous, because I'm looking at it going, oh, God, I'm so glad those kids in Africa are getting a better lifestyle while I'm losing, right? You don't think like that. You think in your own world of going, well, hang on, I'm worse off, right? Well, I don't give a shit that the world's got better. I'm worse off.
Yeah, well,
right?
What's the definition of the world, right?
Yeah.
Is he looking in a mirror or...
I am so glad Warren Buffett's made so much money when I've lost on the stock market, because on average, we've both of us are, we've come out winners. It's just that he's won a shed load more than I've lost, right? And that's what I mean. You can't say statements such as, general statements such as, oh, the world's got better. Okay, yes, on a global basis, but the world is made up of 7 billion individual entities. Some have done really well, some have done average, and some have done below average.
Yeah.
Right? That's what's going on. And so those statements such as, oh, look at the market investing in this period. It's like, well, I wasn't born in 1870, or I wasn't investing then, or I didn't have enough money then. So you've got to look at those specifics. And that's why we teach the general principles by saying, if you asset allocate properly, if you rebalance, right, when the time comes, you'll know it if you pay attention to market cycles.
Yeah. Well, it's like, I think you said in one of the recent week that was that there's a room of 10 people, the room's worth over $1 billion, but 9 of them are homeless, and one of them's Bill Gates.
Yeah.
So it's the same concept. Yep. The room itself is really, really wealthy.
Oh man, those you see that group of blokes over there? They've done fantastically well, right? And the group is the 10 guys with Bill Gates in it.
Yeah.
Right? On average, those blokes have killed it, right? Well, that's what I mean. There's 9 blokes there going, this sucks. And there's 1 bloke going, this is fantastic.
Yeah. Anyway, moving on. So Wednesday we've got the top 10 stocks market cap surges to 20 trillion milestone. And this is just a good indicator that everyone's gambling on the top 10 stocks. And if they decide, if they have a bad couple of years, they're likely going to drag the rest.
Yeah, they're going to drag the rest down. Yep.
Which is basically your FANG stocks.
Yeah. Thursday, we better get going. Thursday, this was just a bad day. I think it roughly it went down 1.5. Now, the reason I point this out is because prior to the last few days before this, they're writing in the paper going, oh, the ASX has had a great year, right? And it was about 11%, right? And then it ends the year at about 8 or 7, I think. In fact, I think it was about 6.5. So my point being, you go, woohoo, 11%, that's really good. In 2 weeks, you go, what the hell happened there? I'm now back down to 6, right? Things can happen really quickly, and you've got to pay attention to that. And that's why I say when markets are expensive, just last night, we're doing this on, what are we doing? December the 28th.
Yeah.
The 27th, last night in the US market, it fell 1.3 in the S&P. Right, so there's things like that where you go, I'm doing all right this week, and then it's like, oh no, I'm not.
Yeah, but it's also worth mentioning that there are up days and there are down days, and
that's what I mean. You've got to match that time frame, and be aware of what we do is try to teach people about the up days, down days, moving averages and stuff, so people can say, oh yeah, okay, I know what's going on.
Yeah,
Jacob said we'd have big down days, 5 a year. Oh, okay, well, this is probably one of the 5.
Yeah.
Right? Rather than going, oh, my God, this is like really bad. Whereas you say, yeah, don't worry about it, mate. This is how it works. Then you go, oh, okay, all right, okay.
Giving people...
I don't need to panic. Why? Because Jacob's given me some information where I've gone, oh, right, so this is sort of normal. Yeah. Oh, okay.
Get on with it. Yeah.
Right.
Cool. Friday, so economists who insist on government not spending and rate cuts. So this is saying, so New Zealand's in a recession at the moment, right?
Yep.
We're in a per capita recession. New Zealand are likely going to cut rates to whatever they do, and people are going to go, you know what? I'm not going to borrow anymore. I need to stop.
Here's the rates at 3%. No thanks. Here it is at 2.5. No thanks. Here it is at 2. No thanks.
Yeah.
Okay, we'll spend some money in the economy. No, I'm just going to pay down my mortgage. Why? Because things look really awful.
Because I was this close to losing everything.
Yeah. That's why I say, the argument about rates is not entirely correct, because there are periods of high debt where, well, let me put it to you this way. Japan's had zero rates for 30 years. How are they going? Right? They're not going anywhere. Why? Because they've got too much debt. Mm-hmm. Right? So there's a whole raft of subtleties rather than just we'll cut rates and the economy will improve. They cut rates in 2000. Greenspan cut rates. Stock market still fell 50%.
Yeah. I mean,
well, hang on, but it's not supposed to do that if you cut rates. And it's like, maybe it's not about rates.
Yeah. Oh, and the whole nation's been scorned. They're not going to just...
Absolutely. Yeah.
Sorry about that. Anyway, so best performing asset classes in 2025. Obviously, US equities have done fantastic. Global equities have done pretty well as well. But
the expectation is they're going to do another, great third year in a row. And as I said, look, it may do. 96 to 2000, it doubled in 4 years. So that's great. But again, the party stopped in 2000, and what did you do? You lost all of those 1996 gains.
Yeah, and that was a CAPE of 44, right?
Yep.
Yeah.
So, now we're back at 39. Well, got to say to you folks, it's not like CAPE at 10.
Yeah.
Right? That's why I'm critical of people who just sort of do this bullshit stuff of, like, oh, yeah, you're just buying the market and blah, blah, blah. It's like, look, that's just really plain dumb.
Yeah.
Right? We have enough evidence over long enough to say, all right, if you do it now, you're, in America, you're going to be in, you're asking for a punch in the face. Now, it might be next year or the year after, but it's going to get there. And it'd probably be a smart move to just reduce your asset allocation to the US and, maybe look at other markets. Emerging markets are cheap, stuff like that.
Yeah. Cool. Short story. So, I mean, we've talked about this time and time again. Biden ratcheting up AI chip war with China.
Yep.
Did you want to cover anything on that?
All I'm pointing out there is the trade war is getting worse and worse, right? We are not going back to the old way, right? Just to December, Boxing Day, December 26, I think it looks like a Chinese ship has cut 2 underground sea cables, from Finland to Romania, I think it was. I think that's wrong. But in other words, the Chinese have done this before. They're doing it again. The Russians are doing it. They're doing it on purpose to disrupt the US alliance and NATO in Europe, right? So they are acts of war. That's like me going to China and saying, I'm going to put a hole in the Three Gorges Dam and, you better fix it really quickly or else it's going to flood, 100 million people downstream. The Chinese would go, that's an act of war. Well, this is what they're doing, right? If we responded and said, righto, okay, you want to play that game, we'll up that side of the argument as well, right? That's why I say we've got, people have got to start paying attention to this stuff, because this is the stuff that moves markets.
Yeah.
This is the stuff where, oil goes from 70 to 150 real quick, right? Because we've got all this subterfuge going on in these, in these places that are fairly remote but are full of infrastructure, right? And the undersea cables, as I said this 5 years ago, we are going to have parallel universes, right? Because we can't allow the Chinese to use the data from or be able to hack into our system. Well, the only way we can do that is say, we're going to build a highway right beside yours and you're not going to get on our highway and we're not going to get on yours. We'll keep trying, but we're not going to do it. We're going to run separate systems.
Yeah.
Right. That's the thing. You know, like Biden's doing the AI war, new restrictions on US investment in China. Biden spoke to Xi about, I think it was 12 months ago, about doing something about the fentanyl trade, right? Because it's just, you know, drug addicting lots of Americans. Yeah. Well, now they're saying proposes a set of bills to hit China over fentanyl trade. So Xi's gone back and gone, yeah, fuck, I'm not doing anything about that, right? So this is what I mean. Now China has this week again talked about, I think it's gallium and germanium exports again. So this is a really serious thing going on.
Yeah, well, it's only going to ramp up in the first half of next year anyway.
Well, if you got a bloke like Donald Trump there, mate, who's, you know, telling Canada they should be the 51st state and they, you know, we're going to buy Greenland and the Panama Canal. All of those issues are about China, right? And that's what's going on. You know, there's going to be more and more of this, and it's going to be really volatile for markets.
Yeah.
Now, I don't know how, you know, what time frame, and as I say, if I knew it was March the 2nd, I'd be saying to folks, get in till March the 1st and then sell everything, right? So I don't know, but I'm just saying there's a lot of triggers out there for events where you go, holy hell, you know, the Chinese are bomb Manhattan, or, you know what I mean? Like they're trying to take Hawaii or something. And that's when markets go, righto, it's time to take all of these big profits I've got.
Yeah.
I'm going to take them.
I'm just going to kind of sit this one out.
Yeah, well, I'm not going to, you know, I've had a 15-year bull market. I've made 500%. You know what? I think I might just take it off the table.
Yeah.
Right?
Yeah.
And then suddenly everybody starts doing what everybody else is doing, taking it off the table.
Yeah, I mean, there's a high probability of a black swan event. I think we
just don't know what it is.
Which one it is specifically.
Yeah. That's why, just to finish off, I'm a little concerned because what I know is when stock markets fall a lot or property markets fall a lot, it damages a lot of people, i.e., it damages economies and people's lives, and that's where you go, you know, you can't have a 50% stock market decline and go, yeah, but things were really good. It's like, nah, that's not the way it happens, buddy. So, you know, that's why I'm a little bit sort of circumspect because I don't, you know, as I say, we're not at a caper 10 where we're going, oh, man, we've ridden out the hard stuff and now we look like we'll be all right from here. We're not at that point. We're at the other end of the point where we're going, woohoo, things are great. Things are fantastic. You know, it's like, is that a bomb on the horizon? It's like, oh, no, it's all good, you know.
Yeah.
So anyway, Merry Christmas.
Merry Christmas, eh? Lesson of the week, I think we've already spoke about lesson of the week where Chinese economy rescue efforts, but did you want to touch on that?
Yeah, just saying what we've already talked about, right? Which is if the biggest government, you know, Communist Party in the world can't save their property bubble, what makes you think Australia can?
Yeah.
Right? What makes you think Japan can? America, Spain, Ireland, Italy, Germany, it's everywhere. And that's why I say if governments could do it, please explain to me how they're going to do it, right? Because we know that rate declines don't do it, right? New Zealand's in recession, prices are falling and people are not borrowing. Okay. What's the other lever? Well, governments can spend lots of money. Well, yes, that's one thing, but it doesn't mean, you know, house prices might stabilise, but it doesn't mean they're going to be going up at, you know, like Perth's gone up 80% in 4 years.
Yeah.
Well, that's probably unlikely to go up another 80% if the economy's, you know, in trouble. Right? So that's what I'm saying. I'm just saying you have to, instead of bland statements of like, oh, Albo will fix it, it's like, okay, let's just gameplay that. How if Albo would have already fixed it.
Yeah.
Right? Because he's copping it electorally. He'd be going, listen, dude, we've got to fix up these markets. How do we do that? Spend money. Okay, right, let's spend money. Well, he's not doing that.
Yeah.
Right?
All right, we'll cue the social media warriors that disagree with us. And roll
Get in there and argue. I'm happy to have an argument.
All right, thanks, Steve. We'll see you next week.
Cheers, buddy.
As always, remember, we don't provide financial advice.